What's going on, everybody? It's Matt, aka the Lumberjack Landlord. Yeah, I'm leaning back in my chair because, oh my goodness, boot camp last night was crazy. We went for 3 hours. Super tired. Because after I finished talking about all that stuff for all that time, holy cow, I'm just like, I cannot go to sleep. But we're here today because I wanted to talk about creative buying of real estate. I think it's really interesting. Certainly there's 1,000 courses out there, and there's all, creative finance and seller finance and bank finance. And I just think, okay, let's shove them all together. Let's make some financing sausage. And so the reason I say that is because very often what you find is that when somebody's trying to take on a lion's share of the risk, right? So with a bank, 97% of the loan they're going to own, they're a little bit nervous, and they have a lot more hoops to jump through. They have a lot more things that they want you to do, a lot more things that they want to make sure. We need to make sure of this. And if it's FHA, we need to make sure that it's move-in ready and that there's no major repairs. And so you'll sometimes hear on those appraisals, you'll hear a concept of a C score. The C stands for condition, and then it's rated 1, 2, 3, 4, or 5. If it's a 4 or a 5, FHA will not write that loan. And you'll find out very far on down the path that they're not going to write that loan. They exist in other types of loans as well, but they're usually a little bit more lenient. So the really interesting thing to kind of watch in this process is that people are either trying to get every single deal seller financing, and we do every single deal seller financing and never any money down and blah, 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 blah. And in many cases, that's true, and you can do that. And sometimes it's because you're partnering with the seller. In other times, it's because you've brought other partners in that are funding the down payment. So the idea of no money out of pocket to buy real estate, it's true. It absolutely can happen. The question is how'd you get to that no money down, right? I'm a devil in the details guy, as I'm an operator. I'm an operator. And because I operate my units, I don't just want a bill for $250 from one of my guys. I want to know okay, tell me about the repair. What is it needed? Give me some notes. I just need some notes. I need a couple pictures and I need notes. And so that for me is something that's really important when it comes to the seller financing piece as well. I think really often what we find is people get really used to doing something, and then that's the only way that they do it. They either buy straight off of MLS, like my buddy Dion. Nothing wrong with that. He still finds great deals. People start buying only through wholesalers. Okay, that works. That's okay. But for a long time, there weren't really any good deals. Dion and I used to talk about how a lot of the deals that we saw from wholesalers, they were too embarrassed to bring those to market because they were too expensive. And then you've got guys like Millennial Mike. He kind of buys them through his crew, but he's also bought from a wholesaler. He's also bought from a broker. He's also bought from a PM. And then he's worked out the deals specifically, with the seller to create some sort of a package. So I think all of that's really important. But I think what a lot of people miss is the idea of spread risk. And when you can spread the risk, you can get far more favorable terms. As an example, with Steve Dow, Velocity Mortgage, Steve was great to work with. They were putting me in a position where, as a product that they offered, and this was from Mike Zuber, One Rental at a Time, they had a product that was 50, 40, 10. It was 50% from the bank. Basically, Velocity would pay 50%. The seller would carry 40% of the debt. And then that meant that I could come to the table with only 10%. Now, how could I fund that 10%? I could fund it out of my own money. I could fund it. And I think on Velocity, I think most DSCRs, I don't think they care where you get it. I think technically you could actually pay for it with your credit card, technically, or take a cash advance on your credit card if you really wanted to be crazy. Not recommending that, obviously. But you can get that down payment from anywhere. So technically you could have the bank getting 50, them getting 40, or the seller carrying 40, and then you finding 10 somewhere else in the equation. Could be anywhere. Hard money, could be a personal loan, could be whatever. So you could technically be no money, no actual money that you had to save up out of pocket. Doable? Absolutely. Now, the challenge is with a DSCR loan is typically rates are higher. Why? Because they're not judging it based on anything other than your credit and the ability and the cash flowing asset itself. So not the appraised price, right? They're looking at the cash flowing asset is does it make enough money essentially? And it obviously just needs to appraise out. So what's really interesting is as we continue to look at these different elements and pieces, I went and I said, okay, I like that idea of that 50, 40, 10, but what will my bank do? Well, most banks, you can have the conversation with them and say, this is a product that exists somewhere else. Is this something that you guys will be willing to do? Now I've taught, and I teach it in my course, but one of the things that I talk about is who's the person that you want to get to in a bank? The person who actually owns that decision is not a CEO. It's not their treasurer. It's not their CFO. It's somebody called the senior lender. The senior lender is the person that actually, in almost every case, owns that decision because they know what the health of the bank is. They know what the rules of the bank are, and they're trying to properly assess risk to understand, hey, this is an asset that we want to participate in. But here's the interesting thing. That bank really cares most about being in first position. Because in almost every loan that they do, they're going to be in first position. The reason that that's important is because they're the ones that technically own the asset, and they're the ones that would foreclose on you. They're the ones that would take the asset back, etc. But think about it this way. If you go from an FHA loan, which they're originating that loan, they're not usually going to hold that paper. They're going to sell it to FHA. But if you were the one buying that property and they are saying, hey, we have to 97.5% or 96.5%, 3.5% down, even 95, even 90 on a conventional, something like that, right? What if you could call your bank and say, I want to take out a 50% mortgage? They get to be in the deal as the first lien holder, but only have 50% of the capital at risk. What does that do? That will get you a better rate. It will get you likely better terms. And so they get to have that first position in a loan, but not have all of the same value of risk based on being at 96.5 or 95 or 90. They get first position with only kicking in 50%. So what are they looking forward to? They're saying, hey, worst case scenario, this guy defaults and big deal. We own the asset for half price. You're going to get better terms. That's a fact. That's how it works. And they know that because they're in first position, the other loans are what are called subordinate. They come under their loan. So that seller who's doing the seller finance, they can't knock the guy in first place out. The only thing they can do is pay that guy off, but that's not going to likely happen. So it's really cool about these different dynamics in a combination of seller financing, bank financing, and, essentially buyer financing. You put yourself in a position to really have the utmost flexibility on how you want to construct the perfect deal for you. The idea is, how do you then communicate that to them? And it can be a number of different ways, which is people that don't own the asset outright. They don't own the house or the multifamily outright. And so they say, I don't own it outright. I got to pay off my mortgage, but I also want some money, but it's a rental investment property. So I'd also like to get some revenue too. Hey, perfect. That's all the things that I can do. And they're like, explain that to me. The bank's going to give you that 50% right when we close the deal. You're going to get my 10% right when we close the deal. So what's going to happen is likely that's going to pay off your mortgage. It's going to give you a little bit of money left over. And then here's the cool part. The seller finances the rest of that and now is making income on that asset without having to fix toilets, take care of tenants, fix a roof, worry about the next winter storm. That type of a deal really does help put the seller in the driver's seat as well as the buyer. The thing that you're having to watch out and make sure of is, what is my rate? What does my real pricing look like? And then how you structure it from there. But I wanted to just spend 10 minutes covering that with you guys, because I think a lot of people don't actually think and put themselves in the other person's shoes. Why would somebody do that? So why would a bank, right? Let's answer the questions. Why would a bank try to do a deal like that where they're getting 50% of the loan? Why? Because it's no risk to them. It's no risk. They're in first position. If anything happens, they foreclose and they get an asset back that's worth far more than what they're not at risk of their capital that they put into the product or into the asset. They're not at risk of not getting that returned, and it's risk adjusted. The second step is the seller finance piece. What do they look at? I get to still get a paycheck every single month, and I don't have to be responsible for anything other than depositing that check, and in many cases, just letting it come into my account on the 3rd. I don't have to take tenant calls about anything. I don't have to talk to the city. I don't have to talk about zoning. I don't have to talk about a roof problem or plowing or landscaping. I don't have to deal with any of that stuff, right? So there's a second piece. And the third piece is your last 10 or 15%, depending on what the bank's bylaws might be, or what the DSCR loan vendors rates or requirements might be for down payment. And then you look at that and they say, the bank is going to do 7% on that loan. The seller says, hey, you know what? Yeah, because it's only a short term or 7 years or 10 years, you know what? I'm willing to live on 5%. Well, the bank's at 7. Now you're at 5. You're basically at an adjusted, just over 7 or just over 6% rate, because there's a bigger balance that's the 7% and the smaller balance is on the 5%. And then when you average those, it would normally come to 6, but because of the difference, the 50 versus 40, it's a little over 6%. So now you are under market price, right? You're under market price for that asset based on the debt. And then lastly is, what do you get for debt on the other 10%? Hey, depends on where you get it from. You might get it from somebody that's giving you debt at 9%. You might have taken a personal loan out. You might borrow it from friends and family and say, hey, your bank, there's high interest bank accounts out there giving 5. I can give 7 or 8. But again, when it's all said and done, that's how you can do a very creative deal with all 3 people paying in and potentially $0 out of your pocket. So that's what I wanted to cover with you guys today. Talk to you about how that could help. And hopefully that does help you. As I always tell you, we try and create great content for you. So please make sure you click that like button and leave your comments below.